CoreWeave just posted a $2.6 billion quarter, revenue up 112% year-over-year, and the stock jumped 19% in a single day. This is what CoreWeave actually does, why credit markets have been pricing in close to a coin flip chance of default, and where the company says it's headed next. On August 11, 2026, CoreWeave reported second quarter revenue of $2.575 billion, up 112% year-over-year and ahead of estimates. Revenue backlog, contracted future business, not yet booked as revenue, surged 246% to $104 billion. But the company also posted a net loss of $626 million, driven largely by $640 million in quarterly interest expense on its debt. CEO Michael Trader called it, quote, an important inflection point as scale starts to translate into operating leverage. The stock jumped 19% on the news. A great headline number, but it doesn't explain what CoreWeave actually is or why Wall Street has been so nervous about it. CoreWeave is a publicly traded cloud infrastructure company, headquartered in Livingston, New Jersey, trading on the NASDAQ as CRWV. It has around 2,200 employees, a market cap that's swung between $40 and $58 billion just this month, and about $5.5 billion in cash on hand. That's a small headcount to be running some of the largest GPU fleets on the planet. But unlike some of its competitors, this company didn't get there on a clean balance sheet. CoreWeave runs a full stack built specifically for AI. At the center, raw GPU compute, from Hopper through Blackwell to the upcoming Vera Rubin generation. Wrapped around that, its own Kubernetes orchestration layer, AI-native object storage built for training and inference, and serverless or dedicated inference on top. NVIDIA sits above it all as both supplier and investor, holding roughly an 11% stake. And on the other side, every major AI lab is a customer. Microsoft, OpenAI, Meta, Anthropic, and Google all buy compute from CoreWeave. It's not a hyperscaler with everything under the sun. It's a purpose-built cloud for one thing, AI. Here's how CoreWeave actually got here. September 2017, 3 energy traders found Atlantic Crypto, mining cryptocurrency out of a New Jersey garage. February 2019, a pivot, renamed CoreWeave, a $1.2 million seed round, renting out GPUs for more than just crypto. 2023, NVIDIA makes its first investment, roughly $100 million, pre-IPO. That August, a $2.3 billion debt facility, led by Magnetar Capital and Blackstone. The first sign of the leverage to come. May 2024, $7.5 billion more in debt, plus a $1.1 billion Series C. March 2025, an $11.9 billion OpenAI contract, then CoreWeave's NASDAQ debut at $40 a share. Later that year, all 4 major AI labs are signed on. OpenAI's contract alone passed $22 billion. January 26, 2026, NVIDIA invests $2 billion more, its stake climbing toward 11%. By late July, credit markets get nervous, default swap pricing implying a coin flip chance of default. And then, August 11th, the Q2 earnings beat, revenue up 112%, backlog hitting $104 billion. So what does CoreWeave say comes next? For all of 2026, guidance now points to revenue of $12.4 to $13.2 billion, and adjusted operating income of $960 million to $1.15 billion. Its first year of guided profitability on that basis. Beyond that, the plan is to convert the $104 billion backlog into booked revenue over the life of those contracts, roll out NVIDIA's next-generation Vera Rubin hardware as it ships, and widen the product past raw GPU rental with its own orchestration and managed inference layer. The through line, and the bet underneath all of it, grow revenue faster than the debt compounds. $35 billion owed, and roughly $640 million in interest due every single quarter. So what's CoreWeave's actual edge? Scale. It's roughly 10 times Nebius's GPU footprint, one of the largest single fleets of NVIDIA GPUs anywhere. Its relationship with NVIDIA, not just a customer, but an investment. NVIDIA holds roughly 11% of the company and gives CoreWeave early access to new chip generations. Locked-in demand, a $104 billion backlog, and all 4 major AI labs already under contract. And speed. CoreWeave built its reputation getting new NVIDIA hardware online and rented out faster than the hyperscalers. None of that is an accident. It's what happens when a company bets everything on one thing, being first with the newest GPUs. The question is what it costs to stay first. So how does CoreWeave actually stack up against the field? Against Nebius, it's roughly 10 times the GPU footprint, but Nebius holds net cash while CoreWeave carries $35 billion in debt. Against the hyperscalers, Amazon, Microsoft, Google, CoreWeave doesn't come close on breadth. GPUs are its entire business, not one line item among thousands. What CoreWeave has that neither can match? A $104 billion backlog, and all 4 major AI labs already signed. CEO Michael Trader put it this way on the earnings call, quote, CoreWeave reached an important inflection point this quarter as our scale began to translate into expanding operating leverage. Confidence like that is easy on an earnings call. What it's actually funded by is the next question. None of this comes without risk. There's the leverage, $35 billion in debt, and roughly $640 million in interest due every single quarter, growth or no growth. There's customer concentration. A handful of AI labs make up most of that backlog, so any one of them pulling back would hit hard. There's single supplier risk. NVIDIA isn't just CoreWeave's biggest vendor, it's also an investor, which means CoreWeave's entire business depends on staying in NVIDIA's good graces. And there's execution risk. Building out power and data centers this fast rarely goes perfectly clean. The whole bet is that revenue keeps outrunning the debt. So why does any of this matter beyond one company's earnings report? Because CoreWeave is the clearest bet in public markets on the AI infrastructure boom continuing. The bull case, $104 billion of locked-in demand from the biggest labs in AI, and a real edge in getting new NVIDIA hardware online first. The bear case, $35 billion of debt that has to get paid whether or not that demand holds, concentrated in a handful of customers and a single supplier. Credit markets already priced in a coin flip chance of default once. If AI spending ever meaningfully slows, CoreWeave is where that shows up first. So which is it? The purpose-built AI cloud that got there first and is now cashing in, or a company one soft quarter away from a debt problem it can't grow its way out of? Comment your take below.